All right. Good morning, everyone. Thank you so much to those who are joining us live. And I know we have many watching the recording as well. My name is Jenna Witherbee. I'm one of the advisors at 401k Plan Professionals. And today's webinar is about retirement plan design considerations to help your organization recruit and retain employees. And I'm going to talk about why it's important and also share some real life examples from some of our clients who have actually implemented some unique plan design features. Again, my name is Jenna Witherbee. I'm an advisor at 401k Plan Professionals. If you're not familiar with our team, we are a group of advisors that specialize in corporate retirement plans. So we help plan sponsors and their employees with their retirement plans, all the way from selecting and monitoring the investments and fees, all the way to education and group and one-on-one conversations with staff, and really trying to move the needle forward to help people retire with dignity. So today's webinar is a part of our webinar series. These are typically around 30 minutes, and we talk a variety of different topics, not just 401k plans, but a lot of different financial topics. And we have 18 webinars slated for 2026. These are always hosted live, as well as the recordings are posted on our website. We have a whole library, a whole page of our website devoted to our webinars and on-demand education. We also have a YouTube channel, so you can subscribe to our channel 401k Plan Professionals, and this is another way for us to reach people with on-demand education. If you are a plan sponsor, I highly encourage you to attend my fiduciary training webinars. Each year, I host 3 to 4 different fiduciary trainings. This year, we have broken it into fiduciary fundamentals, best practices, and then in action. So my next fiduciary training will be on June 18th, and you can also register at the same time for the October 22nd webinar. You can also watch my 2025 fiduciary training series. Last year, we separated it into 101, 201, and 301. And these are, again, nice, short 30-minute trainings. This is a really great way to solidify and further your understanding as a fiduciary. All right, so we are going to kick things off with a poll. I'm curious, what feature of your plan has the biggest impact on participation in your plan today? So go ahead and answer that. Could be your match or profit sharing formula, having automatic enrollment or auto escalation features, your eligibility, the education, investments, vesting, maybe you're not sure. So think of your staff and maybe the things that they ask about or they appreciate the most. All right, I'm going to share the results. So this is interesting. So a lot of you said your employer match and profit sharing, not surprising. So employees recognizing that benefit of additional dollars coming into their plan and then the compound growth on those dollars, and then automatic enrollment and auto escalation features as well. Thank you so much for answering. So we will do one more. Why does your company offer a 401k plan? And it could be a 403b plan as well. So go ahead and answer that. Maybe it's to attract and retain employees, help employees accumulate retirement savings, improve overall financial health and well-being, and staying competitive with your peers. All right, I'll share these results kind of across the board here, but mostly helping employees save for retirement. I love that. Yeah, we're always curious and kind of looking at that deeper why. We work day in and day out with these retirement plans and get really focused on the mechanics. And I think it's important to kind of take a step back and talk about the why. Uh, 401k plans are an extremely valuable benefit to employees. And according to a recent Fidelity survey, retirement plans are the most valued employee benefit, surprisingly, right? Ranked slightly above health insurance. And I think there's a lot of reasons here. From an employer standpoint, this is a really great tool and a really great way for you to attract and retain talent, especially when labor markets are tight and to remain competitive with your peers. You might, as you're hiring and doing interviews, that question may come up more and more. Do you have a retirement plan? What's your match? What's your benefit like? Younger employees some believe that they won't receive Social Security benefits. Of course, that's not true, but it's that kind of that more of the ownership is on them as an individual. And then older Americans are really concerned about rising healthcare costs in retirement, outliving their money, and inflation. So I have 6 plan design considerations with real life examples. Of course, there's many, many facets of retirement plan design. So we're only talking about 6. And I encourage you as you're listening to think about your own plan. And maybe there's something that you've been considering implementing, having conversations during your committee meetings. And then, of course, if you have questions after this and want to talk more about different plan design considerations for your plan, my contact information will be shared at the end. So here's the 6 different design elements that we're going to talk through today: automatic features, pre-tax Roth and after-tax contributions, eligibility and vesting, match and/or profit sharing, and then distributions. All right, so the first one is automatic enrollment, and this is a major trend over the last several years in the retirement plan industry. Now, automatic enrollment is required actually for new 401k plans, and workers are increasingly just assuming that their plan has automatic enrollment. They may be coming to a new employer from a plan that had automatic enrollment, or maybe their past several jobs did. Um, Nowadays, over 60% of workers in retirement plans have automatic enrollment. And in larger plans, adoption of that is even higher than that. Plans with automatic enrollment, not surprisingly, they have pretty high participation rates. Over 90% is common to see in plans with auto enrollment compared to maybe 65 to 70% on average for plans that don't. And from a survey that Fidelity does every year to over 1,000 different plan sponsors, last year they had answered that in the last 12 months, 22% began offering auto enrollment for the first time. So plans that were already in existence. And then almost a third of plans increased the rate that they auto enroll their employees at. So this is a client example. One of our clients in central Minnesota, MAHUBE-OTWA, they're a nonprofit organization. They have about 200 employees, and their plan design is they have a really, really generous employee match. And that's really important to them as an organization. They know that maybe their average wage is not as high, but they really like to emphasize their employer match contribution. And um, what they were noticing is that their participation rate wasn't as high as they would like it to be. And since we came on board a few years ago, we've done a lot of education and we have moved that needle. They were ready to explore automatic enrollment. And so they were hesitant at first, I would say. They thought, I don't know if our employees, if they will um, not want that, or kind of call us up and say, hey, why did you do that? And we assured them that automatic enrollment is extremely prevalent, and there's actually a lot of data behind a low opt-out rate. And the leaders there thought there would be more opt-outs when we put this into place at the beginning of, I think actually it was about a year ago that we implemented it. And the data has shown otherwise. They haven't had a lot of opt-outs. They decided to add auto enrollment just for new hires going forward. Something they're still considering is to do something called retroactive auto enrollment. So that's where you actually auto enroll not just new employees going forward, but existing employees who are eligible and they're not contributing. And so that's just an ongoing conversation. We have, since we've implemented it just with new hires, of course, we have seen that participation rate needle move, and we're looking forward to continuing to see progress there. Automatic escalation. So this is a feature you could add on top of automatic enrollment. So basically, people that are automatically enrolled, if they're in that default status, you can automatically increase their contribution rate, say once a year, until they hit a cap. And if they want to opt out of that, they can. They can change their contribution percentage at any time. But it's just for those that are kind of in that auto track, let's not have them stay stagnant. Let's have them keep kind of moving that needle forward. And last year, in that Fidelity Plan Sponsor Survey, over 1,000 plan sponsors were asked about what changes they expected to make in the next year, and 22% said adding auto increase to their deferral rate was something that they were planning to do. And this is a feature that is also required for new plans now. And this is very effective, especially when it's coupled with a lower automatic enrollment rate. Some plans choose a lower automatic enrollment rate, and this can pair really nicely versus just boom, automatically enrolling at a higher deferral rate. And that really varies based on the industry, the demographic of your employees, just the internal culture. And those are good conversations that we can even guide plan sponsors through as well. Employees can maybe time their increase with their annual pay or cost of living increases. So some employers choose auto increase January 1st. That's the most common. But you can also say every April your organization has a cost of living increase. You could time it with that. Or maybe you want to time it with the employee's hire date. And so the increase happens on their anniversary. So there's different things you can do as far as the timing. Here's another client of ours, Twin Cities Habitat for Humanity. This is a nonprofit organization in St. Paul, Minnesota. They have over 200 employees, and they have had automatic enrollment for several years. And what we were seeing is that inertia was just taking over. People were getting automatically enrolled. That's great, very high participation rate, but largely employees were just staying at that auto enroll rate. They weren't going in and increasing their deferrals, not even to get the full employer match. And so they added auto escalation effective January 1st of this year. So then employees may reach that full match percentage in 2 years after automatic enrollment. So if they stay in that defaulted status, they would escalate 2 times and then they'd be at the full match. Of course, all the while, the employees can opt out of this. They can select their own percentage, save enough to get the full match right away. That's always an option as well. And for Twin Cities Habitat for Humanity, their objective was not only to help their employees get started saving and just get used to this deduction out of your paycheck, your saving for retirement, but also nudge them forward and get them to the point of receiving the full match. And with a change like this, communication and education is really important. So we conducted several group and individual education sessions. They got required notices, and the data shows, again, not many people opt out. And there's a variety of reasons why people don't opt out, but one of them we know just from talking to individuals is they kind of like that thought of just being told what to do. Someone's guiding me, someone's helping me. I want to do the right thing. I want to save for retirement. I want to invest. And this is just really helping them. The third one is plan design considerations around the types of contributions that employees can make, pre-tax, Roth, and after-tax contributions. So most plans offer both pre-tax and Roth contributions, right? So pre-tax contributions, the money that you put in, you're lowering your taxable income right now. The money grows tax deferred. You pay income taxes each year when you take out the money in retirement. Roth is the opposite. So you're funding your account with after-tax dollars, and you, at that point forward, you have tax-free growth and tax-free withdrawals. Now, through the recent Secure 2.0 legislation, there have been some new rules surrounding that Roth piece, the after-tax portion. So the catch-up contribution, that is an additional amount of money that individuals over age 50 can contribute. There is a new rule effective in 2026. Certain individuals who earned more than 150,000 in the year prior, so in 2025, if you max out your regular contributions and then you're moving on to these extra catch-up contributions, those must be deposited as Roth after-tax dollars. And because of that, really, I should say all 401k plans now have to allow Roth because of this rule. And in your organization, you may not have many people that fall into that bucket where the Roth catch-ups would be required, but it's definitely something to be mindful of. And we've been working with plan sponsors to identify those individuals this pertains to, as well as to communicate and educate about this required Roth catch-up. And last year, just as a side note, that catch-up contribution was stepped up for certain ages of employees. So effective in 2025, employees ages 60 to 63, they have a little bit of a higher catch-up limit. So they're coining the term super catch-up. That's another thing to be mindful of. If you have individuals that fall in that age bracket, just know that their catch-up this year, instead of being 8,000, is 11,250. So this is not extremely common, but some of the plans we work with, they have also opted to add an optional after-tax feature in their 401k plan. This is an additional money source on top of what I just talked about. So this is separate from Roth 401k dollars. And with the after-tax feature, contributions are made with after-tax dollars, and then the earnings grow tax deferred until withdrawn. One reason why plans may want to offer this is to allow a higher total contribution limit. This allows employees to save beyond the annual IRS deferral limit, which for this year, for 2026, the limit is 24,500 plus any applicable catch-up contributions if the person is over age 50. But with after-tax dollars, the total combined limit for all contributions, employee plus employer plus this new after-tax bucket, is 72,000 for 2026. So if you have an organization that you're seeing your staff, a lot of them are maxing out their contributions, this would be definitely a feature that you want to consider. Now, I talked about the earnings on after-tax contributions growing tax deferred, unless they are rolled into a Roth. So a workaround is to do a mega backdoor Roth strategy. An employee may convert their after-tax dollars to Roth, either inside the plan or with an in-service rollover to a Roth IRA, which switches the money from after-tax to Roth, and that would allow future growth to be tax-free. And this conversion strategy is something that most providers, most record keepers can handle. In fact, a lot of them have like an auto in-plan conversion feature. So this strategy allows you to move money you've saved into the 401k into this after-tax bucket, switch it over to Roth. For example, Fidelity is a record keeper that has no online form or an online option or a form. They actually require a call from the participant Once they have their first after-tax dollar that hits their account, they can call and say, hey, I want to enroll in that auto in-plan conversion program, which will convert after-tax dollars automatically to Roth every time then going forward that they hit their account. So this is somewhat of a, a little more elevated strategy when it comes to saving for retirement. Um, you do get a 1099 each year from the provider. If you do these types of conversions, you'd file it with your taxes. And it's a strategy some people use too if they think their taxes might be higher in the future, if they're maybe in a lower income earning or a lower tax income season or a year. Those in-plan conversions, if applicable to your plan, can be really advantageous. So here's a client example. McGough Construction is a construction company in Roseville, Minnesota. They have over 600 employees. We were finding that a lot of their participants were maxing out their regular contribution limit. So the plan did decide, after an analysis, they decided to add that after-tax option. So now their employees can save up to that annual max, that's $72,000 for 2026. That includes their own deferrals, catch up if they're over age 50, the profit sharing contribution, which is discretionary from the employer, and then that leaves another amount that they may save into this after-tax feature. And this is pretty simple for them to navigate. Here's a screenshot of what their website looks like. So you can see they have the pre-tax bucket, the Roth bucket, and now the after-tax bucket. And so they can navigate on the website or the app and change their contribution amount that way. One thing I'll note is you wouldn't want to use the after-tax bucket until you've already maxed out your regular contribution. So that's an education piece as well that we're constantly working on. All right, moving on to eligibility and vesting. So recent trends are showing shorter eligibility requirements, and I can attest to that working with a lot of different organizations. A lot have shortened their length of service required to enter the plan. Even a lot now have immediate eligibility, and a lot of plans are moving to shorter vesting requirements on their employer contributions. And this really helps employers to attract talent, especially in a tighter labor market. And some plans even opt for dual eligibility. So that allows two different eligibility periods. Maybe you want to let your employees save on their own right away, but you want to have them wait longer for the actual employer contributions. So here's an example of the dual eligibility. A client of mine, Neon One, they're headquartered in Chicago and they have over 150 employees. They used to have a 6-month service requirement for both deferrals and their employer match. And they recently just changed to dual eligibility. So they shortened the deferral service requirement just to 2 months of service, still having a buffer there for any, short-term turnover. And then they maintained the 6 months service requirement for their employer match. That helped them with attracting talent. Say, hey, you can start saving right away, or start saving into the plan after 2 months. Then the match kicks in after 6 months. And then speaking of match, so employer match and profit sharing is definitely a design aspect that's important for plans. Whether you have a match or profit sharing, both can be used in a similar manner. Match formulas can be very creative. You could do dollar for dollar up to a certain percent. You could do 50% up to a certain percent. You could even have 2 tiers of formulas. So for example, 100% on the first 4 and then 50% on the next 2. So you can really be flexible with your formula. And safe harbor arrangements exempt plans from certain testing requirements if they have a specific match or non-elective formula. And this can be really beneficial to owners or highly paid employees who maybe were prohibited from contributing up to the annual IRS maximum because of certain testing requirements. 401k plans have a discrimination test that they must comply with every year unless they have a safe harbor formula. There's basic safe harbor arrangements shown here, different match formulas, or a flat 3% non-elective contribution. There is something called a QACA, a Qualified Automatic Contribution Arrangement, that is safe harbor, and that allows a short vesting schedule. That has a 2-year cliff vesting schedule. Moving away from a match, if you'd rather have a profit sharing formula for your plan design, there are creative ways you can do this: new comparability, age weighted, or integrated with Social Security. So all of these types of designs and formulas are great conversations to have, not only internally, but at the investment committee meeting table. So here's an example. A client of mine, Ascension Point Recovery Services, they're headquartered in Coon Rapids, Minnesota, over 150 employees. They didn't have a safe harbor arrangement right away, so they were failing this non-discrimination test. And what was happening was some of the higher paid individuals, the executives, were limited in what they could save into the plan because of these discrimination rules. And so leadership decided to add a safe harbor match of 100% up to 4%. Now the plan doesn't have any of those testing issues. Everyone's able to max out if they want to. Everyone's able to get this safe harbor match. And so it's very generous. It also has a 100% vesting attached to it. So that really helps them with attracting and retaining talent as well. And lastly, distributions. So from a design standpoint, some common distribution options: in-service withdrawals. Once your employees hit age 59 and a half, they can take money out with no penalty. Hardship withdrawals are very common. People can take money out for certain IRS considered hardship reasons. Loans or hardship loans, I would say that's about 50-50 with our plans. That's where an employee can borrow from themselves, borrow from their 401k account, and pay themselves back through payroll deduction back into the plan. Now, with recent legislation, Secure 2.0, there are some optional enhanced distributions. So you can see them listed here. Certain reasons, there are limits that an employee can take out. There are repayment options in the first 3 years following the distribution, and they are self-certified. Notice they're penalty free. So these are ways that employees can get access to their account or access to some money from their account penalty free to pay for these certain reasons. And back on that survey, plan design changes made in the last 12 months, 22% of the plans surveyed began offering these emergency savings accounts, which is a way for employees to access up to $1,000 penalty free for what they would deem an emergency that came up. So here's a client example: Minnesota Society of CPAs. They're a professional service organization in Bloomington, Minnesota, about 30 employees. And they recently decided to add these enhanced distribution options to their plan. And they communicated the changes to their staff. So birth and adoption, terminal illness, domestic abuse. If you live in an area that's considered a federally declared disaster area, and emergency expense. And the reasons behind why they decided this was to improve their employee financial wellness, again, retain and attract talent. I continue to say that with these design features, and just give their employees more flexibility with their money. Okay, so some additional resources. I mentioned our website that has a whole page with upcoming webinars, as well as a library of all the recordings of our past webinars. Our YouTube channel mimics that same thing, so it's a really great way to get a notification when there's a new webinar that's been added to our library. So looking ahead, we have several webinars that are geared toward plan sponsors. Cyber wellness next week. In June, one about private assets and retirement plans, my fiduciary training, and then a couple this fall. And then for everybody, plan participants and plan sponsors, we have several coming up: retirement by generations for Gen X, health savings account investing. We have our quarterly economic and market update, Medicare, and millennials. So here's the total. I said there was 18 webinars for 2026. You can register for any number of them. Even if you can't attend them live, always just register if you're interested in it because you'll get sent the recording automatically. And thank you so much for joining today. When you exit out of here, you will have a really brief survey, so please fill that out. If you have any questions, you can contact me here. And I really appreciate your time this morning. I hope you learned something, and we'll talk to you soon. Thank you. Bye bye.